Good morning, everyone. So this panel, we're not going to really deep dive, but we're going to cover cryptocurrency market and also prediction market. And we have experts here that represents a full stack of FinTech. So the issuers, Circle, the Capital, Chaplink, the Plumbing, Stablecoin, and the truth layer, Alien. Now, so to get started, I think we are going to look at the truth a little bit for 5 minutes of presentation of what the truth says on the crypto market, stablecoin, and prediction market, right? A short presentation just to give you background before we start the discussion.
Yeah, a lot of pressure to be deemed as the truth layer. So thanks for the panel for letting. So we're gonna go through a very quick 5-minute overview, just some data, some charts to kind of like frame the.
Should I get out of this?
No, it's fine. It's okay. No worries about that. There we go. Yeah. So no need. Please. No. And then I can call you out as well. Oh, that's true. Okay. Anyway, so. All right, I have 5 minutes. I'm gonna look at my watch right now. Let's go. So just three quick things that we're gonna go through very quick about stablecoins, tokenization, and prediction markets. So I think for a lot of people in the room, maybe like not too acquainted. So the whole point of this presentation is to quickly get that overview. So next, yeah. So as we all know, stablecoins are proliferating, right? So there are many. As a result, there's a lot of different stablecoins to standardize, a lot of different tokens, and one of the things that the key considerations is circulating supply, right? Because it's not just about how much is issued, it's about how much is circulating in the ecosystem. And so there are considerations like how do you know what's native versus bridge supply, pre-minted versus locked supply, price calculations, and also all the different chain-specific quirks. Happy to send the slides later as well. So, and right now we actually have this very simple publish of like, okay, total supply, you have 100%. Once you take out issuer, treasury, unreleased pre-mints, you get down to, let's say, 95%, right? And then you remove a lot of like the bridges, all the different currents, all the different tokens that's locked up in DeFi contracts. And so why does this matter? Because you're a regulator, you're trying to do market float analysis, you're doing a risk assessment, like you want a different flavor, right? You want a different flavor of this metric. And that's, a lot of this is just to educate the nuances of blockchain data, right? And going to the next one, a lot of the volumes today, you look at the headline numbers, you always see headline numbers on news articles, and it's like, oh, X trillion of volume, X trillion of this. And this is one thing that we did with Visa about 2+ years ago, right? So if you see the green here, you have to adjust for it, right? How do you adjust for it? You want to remove like smart contract token transfers. You want to, remove a lot of intra-entity money movement. And so to really ascertain what stablecoin volumes correlate or correspond with real-world payments. Next slide. And as we can see over here, we did this report with BCG about a month ago, and even breaking down what is B2B, B2C, C2B, C2C payments as well. And one of the things that we see that 35% of B2B, 35% of the volume share corresponds to B2B today. And also, I think a lot of the cross-border right now, also from the data, we estimate about 60% cross-border. That's not ground truth. I don't know if Jalapa put a lot of pressure on me, but that's really the estimate right now. Okay, so very emerging agentic payments. I know no one has talked about it. I just want to say this is nascent thing. Imagine machines paying other machines, right? Another part is also card payments. Is also nascent. ETHFI is one of them. And I think Caitlin from Custodian Bank talked about Traces in the Dark, the book. I actually have an autographed copy of that by the author, so I'm very happy. Put it in the office. But over here, you can see she mentioned a lot about clustering. And the funny thing about blockchain data is that almost everything is public, right? I mean, everything's public, but then the difficulty is how do you normalize, standardize, and make sense of it. Cool. So now going up to tokenization, we have 2 minutes. So over here, you can see that tokenized, the tokenized rates, going up to like almost $14 billion market cap. And there's a lot of, you can just see the slope of this curve, right? Like this is not going away. I think we have people from Ondo here as well, right? Over there, Justin. And so I'm trying to make sure that our data is correct and not to reflect you correctly as well. One of the interesting things we want to talk about. So non-US and US focus. So for the tokenized equities, you can see over here, these are like non-US focused tokenized equities, right? They trade 24/7, right? I just want to show you like this is a continuous graph. On the right side here, for middle, this is only US investors. You can see that the trading patterns are concentrated on weekdays. You can see all these gaps here. So that's really the point that a lot of the different usage differs by geography and also use case. And also for Canton, you can see the same patterns apply as well. All right. Synthetic models today dominate. 90+% is in Ondo and X stocks, right? Synthetic tokenization. I think that's really, but it's growing. That's the point of this. And Figure also still nascent. I'm sure Figure that, and also a lot of the trading and transfer volume are in the US today. Cool. And one of the more interesting things that happened in more recent times is that you can see that price discovery is also now happening on chain 24/7. When the Iran war happened, right? If you look at it, when the Iran war happened around here, you can see this is hyperliquid and on-chain perps. For all the oil perpetuals, the open interest increased, like this is oil. I think the orange piece increased a lot since the Iran war because there was a lot of price discovery happening outside of US hours. Last but not least, prediction markets. I know people talk a lot about that. And you can see over here that sports, crypto politics have, of course, grown to rule prediction markets in terms of the volume. We use open interest because it's actually harder to inflate because it actually shows the, like money at stake, money at risk here to show the different, to show similar growth projections here. These are the top markets. And I think a lot of people said our prediction market is the wisdom of the crowds, right? Like the data actually shows that prediction markets today are very highly concentrated. And you can see over here that like most of them dominate. So the power law applies, of course, right? 10 million, 100 million, like those few whales basically dominate a lot of the trading here. And another curve here, 65% of them are produced by top 1% of traders. And one of the interesting things that for more than half of the markets out there, if you have $11,000, you can actually move the price by about 2%, right? So you can actually move the markets pretty easily for a lot of them. And a lot of, I mean, since it's the Federal Reserve here, so you can see that even for the different prediction markets, how they all, based on the key news events that happen, and you can correlate that to the price of, the market actually jumps before the day of announcement, right? That's something interesting. Oh, and last but not least, I think outcome accuracy improves this market approach resolution as well. So this is more like if people are taking a directional bet on just prediction markets. Cool. Last but not least here, inside, not really inside, unusual behavior patterns, right? If these are the different, we can go more in the panel. And I think that's it. Thank you so much for your time. Yeah. So I was very fast. I guess feedback for that too fast, but this was meant to frame the conversation and like please the esteemed panelists there.
You made me want to sit through the hour-long version of that presentation.
Thank you very much, Ethan. Great job. So before we start the discussion, so let me allow each speaker, we forgot to do that, to introduce themselves, quick introduction, and also I'm going to follow what Brooke did. What would be the biggest surprise in 2030? Okay, at the end of the introduction.
The biggest surprise of 2030. I'm Caroline Hill. I will not belabor my introduction to give myself time to think about the biggest surprise in 2030, but I'm at Circle, the issuer of USDC and EURC. Before Circle, where I joined about 5 years ago, I was at the US Treasury Department for about 10 years. I think the biggest surprise of 2030 is if we are still talking and explaining the technology behind blockchains and stablecoins, rather than talking about how stablecoins allows for the tokenization of real world assets, and we move the conversation on. I think for the last several years, it's been how do we understand how blockchains work and how do stablecoins work? And I think in these environments in 2030, we'll instead be talking about gains again, gains from tokenization, gains from T+0 settlement, and how that is benefiting and at times risking others and where the greatest benefits are.
Hi guys, I'm Steve Ehrlich. I am the head of research and head of communications at SharpLink, the second largest ETH DAT out there. I know a few of you, any of you who may have heard of me before. I used to be a journalist. I ran crypto coverage at Forbes for about 5 years. Most people know me for writing that very famous or infamous Sam Bankman-Fried profile in 2022. Before that, I spent 5 years as a senior intelligence officer for the US military. I've been in crypto really since 2012. So I used to say when I would on panels 10 years ago, and may have been the first or one of the first people to ever pass a polygraph test to sit on a crypto panel. So I've been in here for a while. My prediction for 2030, I'll say that there will be more tokenized assets traded than non-tokenized assets.
I'm Justin Friedman, head of policy at Stablecoin. We are a convener of the stablecoin ecosystem, issuers, application builders, bankers, early stage entrepreneurs, investors, and other kinds of enthusiasts. I'm a former regulator at New York State Department of Financial Services, which was the first in the US to build a bespoke licensing and supervision regime for crypto and eventually stablecoins. And I was also a congressional staffer once upon a time, working on Dodd-Frank. So my prediction is that by 2030, almost every transaction will include stablecoins and virtually no one will notice. So that means that, you hear about, people buying their coffee, at retail point of sale in stablecoins. Yeah, maybe some people will. I probably won't. Outside the US, a lot of people, want to receive their wages in stablecoins, maybe because they live in inflation-prone economies, and they want that USD exposure to maintain the value of their income and savings. But in the industrialized world, I'm not sure I really see the retail use cases, but I do see the back-end infrastructure use cases. And so, you swipe your card just like always. You buy something in e-commerce, you're paying for supplies from a vendor. There may be stable coins in the background and you're not even going to know it's happening. And that's perfectly fine.
Cool. Yeah. So I'm the co-founder and CEO of Allium here. So what we do at Allium is very simple. We are the data layer for on-chain finance, right? Any questions you need to ask, we can answer them. My one prediction, make it a bit more not left field, but maybe left field for 2030 is that a lot of payments will be designed, a lot of payments will happen on the agentic payments will rise a lot by 2030, right? Because there's a lot of these, if you see, of course, Silicon Valley, all the companies, everybody using agents. And I think if we all believe that maybe the ratio of agents to humans, especially in an enterprise, would be like 10 to 1, 100 to 1 in the next 4 years, right? They need a way to transact with each other. They need to pay for API services, pay for data, pay for information. And I do think that would exponentially rise. And yeah, that's my one prediction.
Thank you. And my prediction, 2030, I think when I wake up in the morning, my AI agent who already has ordered my breakfast and coffee and decided which currency to make a payment for it. Now we are going to start with some background for each of these firms. Start with Circle. Caroline, so you have been doing a lot of preparation for the Genius Act implementation, right? So tell us about what you have been doing.
I'm not teasing in that I said I fell asleep reading a proposed rulemaking last night and read it the whole way on the train this morning. That's what I've been doing. So obviously the Genius Act passed last summer. And that was many years in the making of I think really serious politicking in Capitol Hill, right? There was bipartisan efforts for years to get the Genius Act passed. And there was the occasional partisan issue that would arise, but largely a bipartisan effort and bipartisan bill passed. But now I like to think that the fun part is happening, and I think I'm preaching to the choir here, where agencies are going through rulemaking around what was in the Genius Act, right? The Genius Act was about 110 pages, and now we've already had over 1,000 pages of rules released because, I think in my mind, and of course I'm biased, but I think Genius Act set the appropriate 30,000-foot framework, but of course the rules need to be written. I've been at Circle for some time now, but Circle has really been preparing for this, since we launched USDC over 8 years ago. So for instance, one of the things that was a main pillar of the Genius Act, and as I think everyone here knows, is the reserve structure. You know, how should stablecoins be backed to ensure redemption, immediate redemption, to ensure the stability of the stablecoin. What is the makeup of that? The final bill and now final regulations look very similar to what Circle was already doing, if not exactly to what Circle was already doing. In my mind, it's not because they looked at Circle, but we both, right, Congress and regulators and Circle and private industry both came to the realization that this is the safest way to do it.
Does it require real-time reserve attestation?
So it requires a number of attestations around the reserves. Right now, we have all of our QSIPs published on our T-bills. We have monthly attestations. There's an audit requirement.
Monthly.
Yeah, so we have a monthly
talking about real time.
attestation.
Is it going to be real time?
Well, it's the attestation of the treasury is real time, right? Because we publish all of our QSIPs, and that's part of it as well. So there are kind of a variety of ways to verify that. Yeah. So anyway, that's how Circle's been preparing, and I think there's still a number of rules to come out. The OCC has come out with rules. Treasury has come out with rules. But there are pretty strict statutory deadlines as well. Of course, whether you follow those statutory deadlines is a decision on the regulator, not the private industry.
Okay, great. Thank you. Steve?
Yes, ma'am.
Bitcoin and ETH, the largest cryptocurrency. And so we have heard so much about the strategies investing 100,000 Bitcoin and all that. So why, I can see Bitcoin, some people believe it is a digital gold, and so it's a good investment. Why ETH treasury?
Sure. So a couple questions there. I'm actually curious, a little audience participation here. How many of you have some sort of exposure to crypto in your portfolios? Good. That's pretty good. All right. Now, how many people have direct exposure? You actually own the assets themselves, even through a Coinbase wallet. Okay. All right. How many people own ETFs that offer exposure to crypto? Okay. How many people own ETH DATs or own stock in DATs, Bitcoin, ETH, etc.? All right. So we have work to do here. So I mean, does anyone know what that is? Depends on how you. Yeah. Not investment advice, but I mean, Jalap, as you said, I mean, Bitcoin has been around for a very long time at this point. It's kind of morphed between a payment system into a form of digital gold to like a hybrid risk / safe haven asset, and it's actually doing really well today along with everything else because of the opening of the Strait of Hormuz. We'll see about that. ETH, I really believe, is a fundamentally different type of asset. It tends to trade in a very tight correlation with Bitcoin along frankly with the rest of crypto. But ETH, I don't think ETH shouldn't trade with Bitcoin any more than, say, like Apple should trade with gold. They're two different products. Ethereum is a multi-purpose smart contract platform that's able to process and handle any type of computational load that you need. And we are trying to, quote unquote, like change that narrative. I think it's important for investors to understand that. And as more and more institutions come into the space, build tokenizing assets, putting it on ETH, or building, like launching ETFs, all sorts of other stuff, I think we're going to change that narrative. Now, to your question, Jalapa, about why a DAT, Ethereum, one of the big differences between Ethereum and Bitcoin is that Ethereum is natively productive. It can provide you with a yield. I mean, just like Solana, just like pretty much every other proof of stake asset out there. What that means is that you can hold it, and you can also get. I think the native staking rate, it changes from day to day, but it can be like, I think it's been like 2.8% ish averaged over the last quarter or so. So you get that on top of the sort of the convex exposure to ETH that we provide. Now, with that, and it's kind of ironic, I actually work for a DAT. I only joined this company about two months ago. I left journalism to do it. Ironically, most of the stories I wrote in the last year were about how DATs were doing a lot of really unfair and dumb things with investors' money, excessive executive pay, or playing games with locked tokens, building liquid stocks on top of it to artificially manipulate that liquidity. And I made a lot of enemies, I would say that. SharpLink was one of the exceptions. I actually didn't write anything about SharpLink. And I actually was kind of worried that my writing would be a problem when they were talking to me, but it wasn't. It was actually an asset. But anyway, to answer your question, Jalapa, like why DATs, if they're done the right way, if they're done responsibly, you can generate excess yield on top of that native staking rate. So we offer you, it depends on the way the DAT is structured, but the ideal one is you get that exposure, that convex exposure to an asset you think is going to appreciate, and then you can get that extra yield on top of even the native staking rate, all within a package that's as easy to hold as an ETF. That's the idea. But obviously there's a lot of differences between different DATs and different assets.
Thank you. Thank you. Next, Justin, stablecoin. You've been meeting a lot of people, podcasts and everything, trying to make it work for banks and non-banks to participate in the stablecoin market. Tell us about that.
So I think
And what's your goal? What are you trying to achieve?
well, yeah. So the goal of stablecoin is pretty simple. It's to convene people who are interested in stablecoins and tokenized things more broadly, and that includes people who are crypto native and are building brand new crypto native solutions, and also traditional financial institutions who are trying to figure this out and what does it mean for them. And they know change is coming and they know their customers are asking for things, but they don't exactly know where to turn. So they come to stablecoin conferences and they interact in WhatsApp groups and Telegram groups and ask a lot of really earnest questions. And that's kind of fun to watch. And what I'm seeing is that a lot of people are panicking because they think the earth is shifting under their feet, and maybe it's not happening as quickly as they think. The reality is, traditional banking probably isn't going to change that much, but it's a question of if you're a mega bank and you have endless technical resources, you're probably trying to innovate and build something original in this space. For the other nearly 9,000 financial institutions in the US, banks and credit unions, you're just going to be a technology taker, right? And you're looking for things that your core service provider can just flip on like a switch. Maybe if you're really leaning into innovation, then you're looking to some of these novel service providers to kind of bolt on solutions to your existing stack. But pretty soon, I think a lot of that is going to be integrated into the mainstream technology offerings that banks and credit unions rely on. And it's just going to be things like, okay, my account holder got paid in stable coins and wants to make a deposit in their checking account. Can we make that transaction work, right? Can we make that exchange work? Or a commercial customer is looking to make payments and they want to make them faster, or they want to receive payments faster. And can we integrate stablecoins into the background so that settlement happens faster and we reduce credit risk? Those are the kinds of things that they're looking for, and they're probably going to buy it, not build it.
Thank you. Ethan, you already showed you had a lot of data, and actually your office was right next to Kaushi in the same building. You have all that data with Polymarket, Kaushi, and also all the Tron data. And you show how raw blockchain data may not be useful. You need to convert them to institutional grade. Tell us a little bit more about why and what you have to do to make it work.
Yeah, so I think people think that okay, blockchain data is public, it's quote unquote free, you can figure it out yourself. I think there are like three steps, as you mentioned. Number one, you have to make sense of it, right? One of the things I like to joke is that blockchains are permissionless and decentralized, which is great. But then that means that anybody can push code to it, which means that we have to clean it up afterwards, right? Your random 17-year-old can ship a smart contract, launch a meme coin token, and someone like us has to deal with it on the back end, right? To filter that out. So that's the first piece, making sense of things. The second piece here, it's translating the data into something that makes sense for even the audience in this group, right? How do we relate from stablecoin payments to adjusted volumes back to B2B payments so that someone at a bank can make a decision, right? Which payment corridor to go for, right? So I think a lot of that is that translation piece as well. And then lastly, at the end of the day, like I like to say that we are always accountable to our data, meaning that like we're not perfect, right? The final charts you see there, but like if like a lot of it's a very interactive, collaborative work with the people we work with, right? And like a lot of that, it's like, oh, okay, this number, this methodology, maybe I disagree with a couple of your assumptions. Let's change this, let's change that. And I think a lot of it is very subjective because a lot of people care about different things, right? And so we have to learn what people want. Like a regulator has a very different lens on circulating supply than maybe like the stablecoin issuer themselves, right? So like I think there's a lot of these different nuances that we work
What
with.
about data on stablecoin reserve? You show for USDT, for example, quite different from USDC.
Yeah, I think a lot of so we primarily focus on the on-chain data. I think a lot of the reserves are also not on the blockchain, so it's hard for us to trace. So a lot of that is that we actually have to pull out all these reports. So I think our level of fidelity there is definitely less, way less than what we have on chain. So that's for Tether specifically. Yeah.
Okay, but at least we know they have gold and Bitcoin. Right.
So they say.
I mean, we have someone from Circle here, but so she said, so they say.
So you also show in your presentation who are using USDC, right? So maybe just a general question for everybody, for all of you, who are using what it is used. We heard before that it's mostly to provide liquidity in the crypto trading activities, right? We don't see much of the retail, not yet at least. So tell us, what would it take to bring this USDC or other stablecoin mainstream for retail payment? What does it take? What is needed in terms of infrastructure or?
I will let Caroline speak
Well, do you
first.
wanna
No, you
see what you see in the data, and then I can talk. Okay. Certainly, yeah. Tell me if you agree with what I say. Sorry, these chairs are very spinny. I feel myself facing that way. So certainly when stablecoins were first created, USDC included, a lot of the activity was for the crypto capital markets, right? It was crypto native firms who didn't want to go back into fiat because that takes time, relies on traditional banking rails. And so they needed a stable store of value of stable coins. And that was a lot of the growth, right? 2018, 2019, 2020 of USDC, a lot of that growth was from crypto capital markets, 2021. But more recently, and I think Ethan briefly mentioned this at the start, and tell me if I'm wrong, we've seen a lot more adoption in cross-border and retail payments. Blockchain data is transparent. It is public. We obviously have our own customers who are also telling us what they're doing. And yet, just because something is transparent and public doesn't mean, right, there's still a lot of interpretation, which means that a lot of people can interpret it, right? You just don't have to take Circle's word for it, but you can take Ethan's data for it and to understand, okay, this much is in retail or this much still in crypto capital markets. We have seen, particularly as regulatory clarity has grown in recent years around the world, we've had MiCA in the EU, APAC countries, of course, Genius here, in that cross-border settlement is really the growing area for retail, for an individual sending remittances, but also at the global company level who are sending suppliers, doing intra-treasury management, any type of cross-border payments is really growing in that space as well.
Could this show in his data?
Tell me if you disagree.
We do have some of it. I think we had a slide there just now that said that I think 35% of the payment volumes that we estimate is B2B payments, right? So that's like non-crypto use cases, and also anecdotally for the like cross-border remittances, that's also a huge use case. I think we have seen that Western Union is publicly launched some. They're like looking at starting out a team in the digital asset space, and they're also not sure what to do. Probably work with you guys in Circle. So I think a lot of these use cases will become more and more common. And I think one of the examples I like to give is like one of the FinTechs, Ramp, right? Maybe they do a lot of expense management, and I think they also started their own blockchain team. And one of the two big parts here. Number one, of course, it's just like cheaper, faster, right, for them, because like I'm a customer of Ramp, and we pay a lot of vendors through Ramp, international vendors as well. So it just helps them make it cheaper, faster, 24/7. That's one piece. But the other piece is that
the stablecoins also allows a US company like Ramp to get non-US customers as well, right? Because they can start, and that is not just like saving quote unquote the bottom line, but it also grows the top line. So I think there are a lot more opportunities, and a lot of it needs the institutions to come in.
And I'll add one more thing. One of the things we look at is USDC usage and holding in wallets below $100. Because I think some of these statistics are distorted by the crypto capital markets because it's moving such large volumes. And so we found that 65% of USDC wallets were holding below $100, suggesting that use for retail payments and remittances, right? Remittances is our big use case. MoneyGram and Western Union are using USDC. MoneyGram is using the Stellar blockchain and has been for years to improve their own internal cost and then pass it along, but those are small amounts.
Yeah. So Polymarket is settling using USDC only, right? And that is what, 20 billion a month? Is that your probably primary usage of USDC in this year, in 20, no?
So it's 20 billion a month in velocity, but that's not kind of holding 20 billion a month. So when we have about 80 billion on chain, that's the circulation, but the 20 billion is kind of back and forth. Their move to USDC was recent, but I don't think it moved total circulation, more than a couple percentage points. But I think prediction markets, some use crypto, others don't, and this is just a move towards like a FinTech using.
What Polymarket only uses USDC.
Polymarket only uses USDC, but Kalshi does not.
I want to add that there are a lot of innovations happening that maybe aren't showing up in the volume yet, but I think soon will. So for any global payments platform, think of Payoneer, which allows people to pay out to contractors around the world, or Ethan mentioned Ramp, right, which serves small businesses that are.
Actually, Ethan pays his employee in Switzerland with USDC.
Yeah. So we have. Oh, yeah. So we have. William here can't even answer it. We have a South African working in Switzerland that that's easier to pay through stablecoins than to pay through other means as well. So
Good for you.
I actually don't know the nuance there, but I know we do it.
So my point here is that you have an established ecosystem of international payments solutions out there that actually depend on a complicated network of correspondent banking to be able to serve as many countries as possible. And, no one serves 200 countries in the world, but, they strive to serve maybe 150, and some only serve, 100 or 50 because it's very expensive and there are a lot of incremental costs to adding each additional country. So if you can abstract away from that, thanks to the internet, by using stablecoins to transfer value seamlessly across borders, of course, you're going to be rushing to do that. And so those companies may not have been the first movers in this space, but they're moving fast now. And you're going to be seeing stablecoins powering those transfers of value and replacing those legacy banking relationships more and more in the coming years.
So when all those companies, banks and non-bank, using stablecoin as a service also, right? The different infrastructure available to them, how would that impact USDC? Is it a threat to?
There's a lot of banking FOMO I would put out there right now around should I issue a stablecoin? I think what we've seen even the last several months is certainly you can take $1 and issue one token as we do, right? Every dollar we get, we issue one USDC 1-to-1. You could create a smart contract to do that, but there's a lot more involved in issuing of a stablecoin, ensuring there's liquidity in the market. Some of the things the products that we build on top of USDC to make it interoperable. I think it can seem simple. Well, I'll just start, a bank will they have to start a wholly owned subsidiary with full reserves backing, right? There's no lending on those reserves. I'll take $1, but ensuring that has liquidity and the technical constraints, it's more difficult than I think it seems. But would be curious.
Okay, so in the beginning, I forgot to mention that actually everything that I say today is my own view and not the Reserve Bank of Philadelphia. or the Federal Reserve System. I'm not just saying that much. I'm just moderating.
And everything I say are also Jalapa's views.
Steve is getting sleepy, so now, tell
Because
us.
the kids get me up.
So BlackRock is offering similar products and use another even bigger ETH treasury with mine, right? So how do people choose who are investing in this ETH treasury, and what kind of questions do they ask? What do they need to know, and why would they choose you over BlackRock?
No, good questions. It's actually kind of ironic since our CEO, Joseph Shalom, was the former managing director of BlackRock, who launched their ETFs and their entire digital assets team. So we really have nothing but really nice things to say. And frankly, there's room for everyone. I mean, the market's growing, the rising tide kind of lifts all boats. The answer to this question was perhaps a tiny bit simpler, I guess, a few weeks ago before the SEC started to allow ETFs of stakeable assets to start staking, like BlackRock, which just launched one. So now the way we kind of answer that is understand exactly the terms and conditions when it comes to how these staking ETFs operate. One of the things that we like to say at SharpLink, and to a certain extent it's true at other DATs and other ones, it's not. It depends on the exact capital structure. If you have debt, if you don't, we don't. So we have no such thing as a liquidation price right now, which I know some people are afraid of, or something like Sailor, because we have no debt to repay. So there's no point where we have to sell assets to pay back principal. So that means that we never have to give the money back. We don't have to redeem the underlying ETH. A shareholder can't come to us and say, here's our shares, give me my ETH back. That's not how we work. An ETF is different. ETFs have to have daily liquidity. They have to be able to redeem everybody. And when you are staking an asset, I don't want to get too far into the weeds on how staking and unstaking works, but there are delays. There's constraints to how much can be staked and unstaked in a given period of time to protect network security. Right now, the entry queue is about 50 days. A few weeks ago, it was 72 days. So if there's a big rush, and the exit queues are just as volatile. So if there's a big rush to the exits because like somehow there's some hack in the Ethereum software or any ETF, any digital asset, BlackRock or whoever can't necessarily give that money back, and that could be a problem for them. They have to have side deals where they can borrow assets or something else. So they often have limits of what they can stake because they have to meet those daily liquidity requirements. Point two, we talked about fees. All these ETF issuers, they charge management fees for crypto ETFs. They're often pretty low, but they often charge separate fees for staking. I think BlackRock, I mean, don't quote me, I think it's around 18 bips or something like that. So that's an additional fee on top of the opportunity cost of not staking all the assets. Once you start thinking about those numbers in big terms, compounding, those can be meaningful deltas, which is something we tend to talk about. But again, I mean, BlackRock's are a great company. I mean, there's room for everybody. But that's how we kind of answer that question. I'd like to add one thing though about stablecoins, because it is pretty interesting to me. One of the stories I wanted to write, but I didn't get a chance to, is the difference between tokenized deposits and stablecoins. And I'm also curious what you think about that too, because if I'm a bank, tokenized deposits actually seem much more capital efficient than stablecoins because they don't have to be fully collateralized. They are FDIC insured. They can be rehypothecated with the same, I guess, theoretical customer safeguards. Now, I certainly understand the need for stablecoins. I mean, more than half of all stablecoins are on Ethereum, so I'm a big believer in stablecoins too. But especially for U.S. customers, I wonder, like, I'm really wondering how the tokenized deposit versus stablecoin debate is going to impact everything, because I do think it's going to become.
Yeah, I think you walked in after Caitlin finished her talk, right? Because were you there?
Which here today or yesterday?
Caitlin today. So there is this conversion between tokenized deposit and stablecoin. When it leaves the banking system, it's converted automatically to stablecoin, and then when it comes back, it's automatically switched to tokenized deposit with the smaller reserve. Anyway, so that is happening now. From what I heard this morning in Texas.
Caitlin's doing a lot of really cool stuff.
So should this ETF? I heard crypto is going to be available for pension fund manager? Is it 401k?
I think they're, I don't know all the details, but I know they're trying to
So
make
ETFs?
it possible, yeah.
So what would be the cautions that you would say?
The biggest caution for 401ks, and I think when I was at Forbes, one of my writers did a story interviewing the head of AARP when they were trying to, because I think they came out and basically said crypto doesn't belong in 401k profiles. Like most questions I get, the answer is it depends. I mean, it really depends on how old you are, how close you are to retirement.
Well, what about between ETF and the treasury share?
Oh, in that case, I mean, I don't really think it, I mean, frankly, they both should be sound and secure. I mean, ETFs are highly regulated and you should know exactly how they're operated, like what the redemption process looks like, what the wind down process might look like, et cetera. They're ultra safe. We like to think our stock is also safe, but anything can happen. But the bigger question, honestly, I think for Jalafa is like this asset class can drop 75, 80%, even blue chip assets. So, I mean, really think long and hard about your time and investment horizon in a not financial advice point away. Before you put it into retirement accounts, like make sure you have time to go through the peaks and valleys, and it's not money that you can't afford to lose.
Add something to this. I think one of the appeals is that people investing their 401k savings don't have that wide of a range of choices. I mean, like, you know, traditionally it's publicly listed securities and mutual funds and ETFs. And so they're looking to take on more risk and more exciting assets that may have greater volatility, like here's their opportunity. I won't opine on whether that's wise or not, but I certainly see the appeal. There, for accredited investors, you know, there are a whole range of other opportunities to invest their savings that are just not available to mainstream investors. And so necessarily people are like looking to take on more risk, and this is how they can do it. So we should probably be asking the question of like, how do we give investors what they want while also doing it safely?
Okay, one last question for you, Ethan. So from your data, how do you make out if it is like some wash trade, like you said, 40 billion a month? It's actually not really a lot of back and forth. So can you tell from your data, like what's the real activity?
Yeah, so I think wash trading is like the same transaction goes back and forth, right? Like I think so we actually worked with a lot of the different NFT marketplaces about 3 to 4 years ago and we actually built a lot of the wash trading filters for them. And we couldn't call it wash trading for legal reasons. I think it was called inorganic or some other word for some legal reasons. Even we couldn't even call it that at that point. And so there are a lot of heuristics you can do to quote unquote calculate wash trading. So if I think even for prediction markets, it's the same person take both sides of the bet, right? And that you can inflate some of the volumes there, especially, and this is especially prevalent when a lot of these different crypto protocols, they give a lot of these DeFi and these incentives to do activity. So maybe about a year and a half ago, 2 years ago, there's probably like an airdrop that happened every week, right? And so on how we actually calculated a lot of the bot activity of wash trading is that you actually cluster all these wallets together. So usually there are a couple ways. It's like if they're funded by the same wallet, right? And in a sequential way, like A to B to C to D, or like one wallet funds like 100 wallets to kind of like hide their activity. That's one. Another way of wash trading or like even circulating money around is that they go through all the different bridges, right? So from one chain, you actually round trip the money across multiple chains to come back to the same the actual same wallet there, right? And so there's so many ways to do it, but at the end of the day, a lot of it is clustering, like Caitlin mentioned, and it's like building a lot of these heuristics and models on top of it. Yeah. Okay, great. Now, just 2 more minutes. So I want each of you to say just 1 or 2 sentences. What would you like the audience to take away from this conversation? Start with you, Caroline.
What I think that the audience should take away is that there's a lot of different use cases for I'll talk stablecoins specifically, right? When people say, what are you using it for? My first question is, tell me about tell me about your business. What are your pain points? Oh, you're paying people in Switzerland. Oh, you have, a global business, or you're here in the United States. But the 1 to 3 days processing time is taking too long, right? And so I think it's not a one size fits all. And it's also not the magic bullet, right? There's not, it's not going to solve every pain point. But a lot of the settlement, delays in payments, cost of payments, in addition to how do we incorporate tokenized real world assets, how do we incorporate AI into payments, right? This is something that can help improve it.
Two quick things. Number one, nothing I said here is financial, tax, or investment advice. So please see those people before making any decisions. But more seriously, I'm really excited about what's to come in crypto. Like I said, I've been in this space for 14 years or something at this point. I mean, I remember when Bitcoin was less than $100, and my wife wonders why I still have a mortgage. I chose to pay off my student loans. But like when we talk about agentic payments, when we talk about tokenization, when we talk about like trillions of dollars that are going to come into this ecosystem. I mean, the Treasury Secretary is saying that stablecoins are going to become like $4 trillion by the end of the decade, up from what is it now, like 300 something billion, like something like that. I mean, there's real money, real projects, real people coming into this space. And I've seen too many hype cycles that have come and gone because they just seem like vaporware. I've seen so many tokens, and I've written about them, that literally are just money grabs that had no chance of ever succeeding. Those are going by the wayside, and we're seeing a lot of attention focused on the projects, the companies, the tokens that have real chances of success, and they're finally solving problems that actually need a blockchain, like agentic payments and micropayments and instant payments that are not possible on today's payment rails. So that's what I'm really excited about.
I'd say for financial institutions, for corporate treasurers who are responsible for cash management, for people who are working in payments and they're doing either receivables or payables, whether it's e-commerce, whether it's B2B, just try things. Like, don't be afraid to experiment. There's a lot of service providers out there who want to take you on as a design partner, and they're so early in what they're building that they want to collaborate with you and figure out what your needs are. So give it a chance and learn and try and experiment, and not everything's going to work. And even if the technology is good, like the economics might not be right, but you'll discover what your business needs going forward if you give it a try, and don't be afraid of it. It's happening. I like to say the internet only moves in one direction, towards wider adoption. And that's what this really is. It's like, value transfer going on the internet and on chain, and we're not going to turn back the clock, so it'll catch up with you.
Cool. For me, I think the one simple takeaway is that I think you'll probably read a lot of things online or articles, headline numbers, and I think my ask is just that whenever you see a number, just make sure that you're extra critical about it, and just think about it how a number was actually came to be, right? Like even the 4 trillion number. Even on our side, we're trying to see how we can add up to the 4 trillion. It's a big number, right? 4 trillion, it's like 10x growth in 4 years. So I think a lot of that data literacy, I'm hoping that everybody just starts learning, because a lot of the data is public, right? Everybody can learn at least a framework by themselves, right? I think that would actually help improve conversations and make everybody collaborate together better. So yeah.
Thank you very much. Great panel, and it's lunchtime.